And we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Thank you for joining us here for one of our regular post-FOMC live streams to make sense of what the Federal Reserve just announced and what Fed Chair Jerome Powell discussed at his press conference. I am joined, as usual, by Axel Merk, head of Merk Investments and longtime Fed watcher. I consider him to be a Fed expert. Axel, thank you so much for joining us again.
Great to be with you. And we can say that offline, we managed to blame the Federal Reserve even for your tooth trouble.
Yeah, thank you. So a couple of things, folks. One, Axel kindly dressed up for me here, so give him props in the live chat there. Yes, I won't go into it today. I probably will over this weekend's update. But yes, this is the first time I've been on camera on this channel after having lost a tooth this past weekend. Not fun. I'm not going to reveal which tooth it was. I may talk a little bit more restrained so you can't see it because it is visible. But anyways, we'll worry about that for later days. I'll also apologize too. In my home studio here, since it's my first winter in it, I'm realizing that there's some winter sun glare issues that I'm trying to deal with, but I clearly haven't solved yet. So bear with me while hopefully in a couple minutes that glare goes away. But anyways, Axel, interesting, it's starting to get interesting here at the Fed at these post-FOMC meetings. The Fed did cut by 25 basis points, as the market was pretty confident it was going to. But there were 3 dissents to that decision, which I believe is the most that have been on the most dissents the FOMC has experienced since 1988, so a good long while. Almost 40 years, I guess, if I'm doing my math right. And here's the key question I have for you, Axel. I don't want to be misinterpreting this too hyperbolically, but the Fed did announce that they will be initiating purchases of basically T-bills going forward to the tune of about $40 billion a month for at least the next couple of months. And they said, well, this is nothing out of the ordinary. This is just to maintain an ample supply of reserves. Is this true? Is this just sort of business as usual stuff? Or is this kind of like foaming the runway? Is this like a QE-Lite that is sort of, getting everybody accommodated so that if the Fed really wants to start growing its balance sheet at scale, it can do so?
All of the above. So Powell really doesn't mean to do QE, but he kind of has to because they have this ample reserve regime where they take down the balance sheet. They don't quite know what the limit is. At some point, you start having some tension in the system, and then they foam the runway, which means they add liquidity. And that's ultimately what the market, I believe, has reacted to. Powell may not want to do this as a quote-unquote policy tool, but of course it is. I mean, the market doesn't care what Powell says. The market cares what Powell does in that sense when it comes to QE. And so, yes, they are initiating QE. They don't mean to do it to ease, but that's what it is. And they need to do it because they have this ample reserve regime. And just for folks who are not so much into those details, the Federal Reserve used to set interest rates until the financial crisis through interventions by the New York Fed. And they were buying and selling, withdrawing liquidity, adding liquidity. And then at some point, Bernanke said, hey, let's make this much easier. We can just pay interest on reserves. And that required an act of Congress because that wasn't permissible before. And ever since then, the New York Fed definitely, and I've talked to several people there, they very much prefer it. They consider the previous method outdated. They say it only causes problems. You have a lot of stress for no advantage. However, the ample reserve regime, I think the technical term is it sucks. And it sucks because politically it's a nightmare because you're literally paying banks billions, tens of billions in order to not use their money sometimes when you provide that liquidity. And also what was good about the old regime is while it was a pain in the butt for the New York Fed to implement, they saw when there were problems in the system. Now they use foam, figuratively speaking, to provide liquidity. And the issue is that different participants in the markets are regulated differently, and for them, the pain point is different. And so nobody knows where exactly that pain point is, because you have overlapping, at times contradictory regulations. And so they just provide enough liquidity for everybody to be happy. And that kind of works, except we see it in the market reaction today. If you don't need any other proof, the market is very happy about it because the market loves liquidity. Now, of course, it doesn't mean everything is right with inflation, unemployment, or whatever it is, but liquidity we have. Liquidity is what the market is reacting to. And as long as Powell is the chair, we will get that regime. And by the way, Powell is on the way out. There's only one person who said he wants to put an end to the ample reserve regime. That's Kevin, not Hassett, it's Kevin Walsh. Whether he'll do it is another question, but he has criticized that regime very openly.
So let's drill into that for a bit. So as I said, there were 3 dissents, I believe 2 that didn't want to cut. And then there was, surprise, Mirren, who said, look, we should do 50, right? And Mirren is definitely kind of on Team Trump here, very, very visibly. And Trump has basically told the market that he thinks Powell's successor, he's chosen Powell's successor, which is Kevin Hassett. I mean, Trump being Trump, he could always change his mind here. So we shouldn't take this as a full guarantee, but that's what the market is now got a lot of confidence in. And Hassett of late, in the past couple of days, has said, hey, I think there's plenty of room here for the Fed to stimulate still. So it seems like Hassett will be probably leaning more the way that Mirren is. So as much as you said, Powell is likely to continue this more sort of accommodated, foaming, should we expect Hassett to be even more aggressive in that?
Well, Hassett pretty much, when he was asked whether he would have been okay with a 50-point rate cut before the rate cut happened, he said yes. So he would have been definitely in the camp of cutting. When it comes to the new Fed chair, I think the actual rate matters less than the approach. And that's in part what I mean with the ample reserve regime, quote unquote, sucks. Is the next Fed chair going to change the tool set that the Federal Reserve is using? Is the Fed going to retire some tools? And indeed, yes, the market firmly believes it's going to be Hassett. As you know, I have favored Kevin Walsh because he's exactly the one who wants to get rid of many of these tools.
Right. It sounds like Walsh should be the one to clean house most.
And to just put the third top person on there, Chris Waller. Chris Waller is somebody who speaks his mind and who is the one who spoke up early against inflationary pressures. He was willing to switch course. At the same time, he is a traditionalist as far as kind of what the Fed does, and so the structural issues wouldn't be addressed with him. They're all 3, by the way, they're good economists, and so the question is whether, of course, they can hurt those cats. And going back to the meeting today, several people, including me, would have been happy to have had more dissents, not because it would have changed the course of history so much, but it would have made it, in my view, easier for the next Fed chair. Some people say it might have been harder, but if we've had more dissents even than we had today, it would have signaled that it is not Hassett or Walsh or Waller or whoever it might be next Fed chair. It is just the Fed that is very, very divided. The other thing that is somewhat surprising is that these people reiterated what they've previously said, at least 2 of them, right? One tradition at the Fed is you express your dissent and then it says, okay, I've made my point and now I'm quiet and I go with the troops, right? And so we're definitely in a new era. The other thing, and sorry for mixing this up here right the stages, because we're talking about the Fed succession. There has been talk quite actively, and Hassett has offered as much, to take not just the chairmanship, but to take Powell's governorship. So context here is governors are appointed for 14 years. Very few governors stick around for the full 14 years. But at the end of those 14 years, somebody else is going to get another 14-year term. And Powell's term runs until, I think, another 2 years or so. And so if Hassett or somebody else were to take Powell's term, and that would of course imply that Powell will step down from the Fed. Everybody expects that. He wasn't. He was asked as much during the press conference today. He didn't answer that question because it wouldn't be appropriate. But it means that we would go through the same theater again in a year or so about whether indeed the new chair is going to do his job, and then you really have pressure on that new person. Whereas if you give that person a slot that's open for several years, then you can have independence, even a Hassett, who obviously some people will perceive to be political.
Interesting. Okay. Somebody here raised the question. I'm trying to see if I can pull it up here, but basically they said that after the cut was announced, President Trump said, here we go. President Trump said, well, they should have cut 50 basis points or 75 basis points. Can you just, guesstimate for us what you think the reaction would have been if indeed the Fed had cut 50 or 75? Would the market still be thrilled, or, with the 75 surprise basis point cut, would the market start getting spooked thinking, oh gosh, the Fed is seeing some breakage in the system we haven't noticed yet?
Well, let me answer this way. The Powell Fed, but also the Bernanke and the Yellen Fed made it a point to not surprise the market whenever possible. And so even the current rate cut, right? You had people come out and say, oh, this market thing about maybe not having a rate cut or this or that is all wrong. Powell didn't need to speak. He just sent his missionaries out to make some statements. And by the time the meeting came about, there was over 90% likelihood in the market that we would have had a 25 basis point cut. If we were under a different regime and had more surprises, then I can speculate on what might have happened. In the current environment, it seemed like an almost zero chance that would have happened. And a lot of people, me included, don't think that's so healthy, right? The idea, and the one thing we had, right? We had a lot of people come out, oh, I'm going to vote for a 25 basis point cut. That is utterly inappropriate. You're supposed to come into a meeting with an open mind, look at the data, and then make a decision. Now, obviously, you could argue, hey, there aren't so many economic data, I've made up my mind already. But the moment you state it publicly, you're anchoring your own mindset, and you make yourself much less flexible in a discussion. And so the new Fed chair, whoever it is, should get rid of this really, really bad habit. Now, I have talked to Fed officials, and they say, well, the regional Fed presidents, they don't report to the Fed chair. They can do whatever they want. But the tone is set at the top. And if they get a scolding from the chair and saying, listen, we got to reform how we communicate, I think it will have an impact. And so all this talk about setting expectations before the meeting, I don't think serves much good and does a lot of harm. And so, sorry for not answering the question, but I don't think it would have been realistic. The market didn't react to the 25 basis point rate cut, I don't think. It reacted to the QE much more than anything else.
Right.
The other thing, of course, we haven't talked about is the Fed said they're on pause now. So they are done, and they'll look at the market. And then he emphasized that.
Is that any different, though, than him just always saying we'll be data dependent?
Yes, because the previous data dependency was that unless something changes, we'll cut again in December. It wasn't so clear, and then it was made clear. Whereas now the data dependency is we really need to see something to change our mind from just holding off. And I mean, there are a few things to be said here. In the medium term, they still expect inflation to be at 3%. That's really bad that the folks at the Fed don't think we can go down to 2%. And by the way, for the current administration, that means that people will still be unhappy about prices, that the real wages are not able to keep up with that sort of the movement. And then he said he expects the economy to be stronger. So that's a change in tone, which he may have said to counter this weight about the 50 basis point rate cut. Folks who might have said so behind the scenes. And at the same time, he says the labor market is somewhat softening. And so he gets everything that he has. He was asked how he kind of squares all that. And he said, He thinks productivity growth is going to be strong, in part because of AI. Of course, there's some layoffs that come with it.
Right.
That's very relevant because, again, some of the candidates to succeed Powell very much count on productivity growth. One of the reasons why people want to have more rate cuts is because they believe that deregulation and other means that create productivity growth will allow a lower policy, will allow more growth as less inflation. So Powell pretty much said, yep, I'm really on the Dovish side. I don't want to be quite as aggressive as those folks, but I actually don't mind if Hassett is a little bit more aggressive here. I mean, that's what I heard in between the lines here, that he is kind of presenting the Fed on a silver plate to Hassett if he wants to pursue a dovish policy.
Okay. So I found it kind of interesting. There's a lot of people I interview are concerned about a slowing economy. Some people are concerned about stagflation. Pardon me?
No kidding. Yeah.
Yeah. Some people are concerned about unemployment continuing to rise next year. And we've had, I don't know if record levels, but certainly very elevated levels of corporate bankruptcies this year. And we're seeing a lot of layoff announcements. Now, Powell shared the Fed's projections. And as you said, he projected that GDP would grow, right? Grow from this year to next year. He projected that inflation would come down, right? I think he said they're expecting something like 2.6% by the end of 2026 and 2% by the end of 27, essentially. So we're going to hit our 2% target within about 2 years. And unemployment, even though he talked about the labor market softening, the Fed's unemployment projections go down over the next couple of years. So he's kind of projecting, I don't want to say necessarily Goldilocks, but like a really kind of nice road ahead, right? How do we...
And you do QE on top of that. You forgot to add that, right?
Well, exactly.
And we might as well do QE because things are so good.
Right. Well, let's cut rates and do QE because everything's going to be so amazing. So I guess my question for you here is, and in some slight defense of him, he did reiterate a number of times, we haven't had all the data we normally have, right? But is he telling us what we want to hear? Or do you think the Fed and its army of PhDs actually believe this?
I think he is the mouthpiece of the debating club from which he just emerged. That was kind of what he took and how he squared the circles and how he was herding the cats. Remember, just 3 months ago, he, I think, was far more honest in the sense that he said, some people have made an excellent case for more growth and some people have made an excellent case for a more severe slowdown.
Right. And he was much more worried 2 meetings ago about the labor market. And he started off by saying nothing's changed. Our outlook hasn't changed since October.
What has changed is that we have no idea what the labor market looks like.
Right, but nothing's changed since he was nervous. But now when he's talking, it's like, it's cooling, but everything should be fine.
Well, that if you're asking me why we need a new Fed chair who has a little bit more of a framework. By the way, what you said, he used the word feel. It doesn't feel inflationary. Mm-hmm. So the Fed is based on feelings of the chair. And while that in some ways may always be the case, I would much prefer a reaction function that's a mathematical formula.
Which you have said ever since I've known you. Yep.
Yes. Now, I think a reasonable person can make a very bullish case for next year for the growth, and a reasonable person can make a very bearish case for next year on the growth. You can argue, as the Fed appears to do, that productivity growth is going to be there, and the big beautiful bill is going to provide a stimulus. There will be some good news in the springtime because a lot of people didn't adjust the withholdings on their wages, and they're going to get some tax refunds. And so who knows whether that's going to carry them through. You can make the negative case. You can say that the tariffs got everybody to cut cost, and that's why earnings look good. They have them hoard goods. They've had everybody spend a boatload of AI, which gives everybody a shot in the arm. But now realism kicks in, and maybe we don't need these most expensive chips. There are cheaper alternatives available than the NVIDIA chips, and I'm not giving a forecast here. The glass can be half empty pretty quickly. And so as far as I'm concerned, I'm an investor. I don't have a crystal ball. I look in the world in terms of risks and what can happen. By the way, one thing we haven't touched on is in other parts of the world, they're starting to price in rate hikes. Not many, like half to one hike. But the ECB, 2 people have come out or so that said, oh, the next move is going to be a rate hike. And so there is a more cautious tone spreading, except for the Fed, where we're battling over 25 versus 50 basis points cut.
Right. And sorry to interrupt, but somebody actually did ask about the possibility of a hike because they compared this to a period in the 90s, which had sort of 3 similar quarter basis points cuts like this, and then the next move was a hike. And Powell basically said that's on none of our bingo cards at the moment.
Well, it's not on his because he's going to be retired, so it's not his problem. But it's, I mean, the honest answer is nobody has a clue. They are obviously looking at the data they have, but what's lacking is a coherent framework, which would allow us to do some more robust testing against all this. The reaction of market is, hey, we got liquidity, right? Yeah. And so we will find out whether the next Fed chair is going to have different marching orders, different priorities. And it's now, presumably, we'll continue to have some chiming in from the president because he just loves to chime in on monetary policy.
Well, I think it benefits him to have the Fed be the villain too. Right.
Well, not just him. Every president has liked to blame the Fed when something goes wrong. It's nobody quite understands the Fed. I had a discussion just I think last week, and the person asked me, "What's the difference between monetary and fiscal policy?" This was a very intelligent 20-some-year-old woman who was politically very active, but had no idea what the difference was. And if I may, because I don't want to presume anything, monetary policy is about the amount of money in an economy, the amount of credit, about interest rates, about money supply. What it is not about is allocating that money to specific groups. That is fiscal policy. That is in the realm of elected officials. I'm a purist on that. To me, the Fed buying mortgage-backed securities should not be done by them because that is allocating money to the mortgage sector. Right. But anything in that direction, and of course the Fed has done a lot, especially during the pandemic, steps on fiscal turf, which then invites backlash and invites the folks on the fiscal side to use the Fed and abuse the Fed. And by the way, to just add to that, the low rates we've had for many years encourage the Fed to initiate this reckless spending. And so there's a lot of spillover from monetary policy onto fiscal policy. Right. And teaching the fiscal side to be more disciplined is very, very difficult.
Impossible. Yeah, almost impossible. Let me just clarify. I've got so much to follow up on from what you've said in the past couple of minutes, but let me just try to clarify this for folks. So the Fed monetary policy, when the Fed quote unquote prints money, what it's really doing is it's creating additional bank reserves, correct? And well, first off, let's start there, correct?
It's literally providing liquidity. We are in an ample reserve environment. There is no more such a thing as there used to be required reserves and excess reserves. We don't have that differentiation anymore. There are always reserves available. What is not available sometimes, if then you just have a screeching hold in the system if credit is not available. And so we are providing quote unquote ample reserves, and the Fed can do that by buying securities in the market, thereby providing cash, so to speak, to institutions.
Yeah. Okay. So a couple of things I just wanted to clarify though is one, if the Fed is increasing reserves, bank reserves, the banks can then lend those reserves out and get money into the economy, but the banks don't have to. They can just sit on them and make free money, right? So I just want to say, in monetary policy, you can have times where things don't go exactly the way the Fed is hoping, right? Whereas fiscal policy, that money is getting directly injected into a part of the economy. So fiscal policy tends to be more inflationary from an economy standpoint. Now, QE, sorry, go ahead.
Yeah, just to be confusing here, Milton Friedman used to say that the reason we have inflation is because of deficits. If there weren't deficits, we wouldn't have inflation. And what the Fed can do, the Fed can stop credit expansion by hiking interest rates so much to make it unattractive. That's really what they can do. But the Fed can keep an eye on the amount of money in the economy, but it's not like they have a fine-tuned thing where they can exactly regulate what's happening. The Fed calls it a broad brush. They have a bazooka, right, with which they can do things. They can enable more credit expansion, and what the Fed can do, they can destroy growth if that's what they choose to do. They can take the punch bowl away. So that is an option they have. But as you point out, they can take the horse to the well, but they can't force
they can't force it to drink. Yeah, and all I'm trying to say is that fiscal policy tends to be more like instantaneously inflationary than monetary policy, with the exception that monetary policy does tend to find its way into the financial markets more easily, and so therefore, that's why the markets are jumping today, right? Is they're jumping because they know more liquidity is coming to the financial markets. Okay, so a couple of things. So Powell.
And by the way, to just expand as to why, let me put on my academic hat, and I'm oversimplifying here. If you value a company, it's the present value of future cash flows.
Correct.
And if interest rates are lower, you're discounting future cash flows at a lower rate.
So the prices should go higher. Yeah.
And so the prices go higher. And if you have great uncertainty about the future cash flow, then this discount rate matters much, much more, because it tends to whack around those valuations, and that's part of the reason why these growth companies, high growth companies, have a greater interest rate sensitivity.
Right. Okay. I'd love to keep talking about this, and I have a few other questions on it, but we have limited time. And folks, I should have mentioned this at the beginning, but we have to end here about 5 minutes before the hour. So I'm going to try to cram as much as my questions in and take as many of yours as we can. So on inflation, let me just ask you this, Axel. So we talked about how the Fed sees the CPI coming down. And he talked about, he said, we're actually seeing services disinflate. We're really seeing the remaining stickiness in inflation is in goods, and the vast majority of that's because of the tariffs. So he said, look, we're basically sitting on our hands at this point, waiting to find out, is this goods inflation kind of a one-off price increase, or is it going to provide a sustained inflationary impulse into the economy? And the honest answer is TBD. We'll wait and see how this plays out. Question I have for you is, CPI calculation is about 40% shelter. We know from more real-time sources than the BLS uses in calculating the CPI that rents are disinflating, home prices in increasing number of places are disinflating or deflating. So personally, from my cheap seats, I'm taking the under on the CPI next year. I think that 40% disinflating shelter component is going to really start acting as an anchor on CPI. Do you have a similar point of view, or do you think that this tariff-driven goods inflation could actually keep things elevated for longer?
Well, I wonder whether it matters. So let me start out by saying it appears that Powell has been listening to Fox News, because Dissents has been on Fox News touting this thing that services inflation is down. So he's taking kind of the party line.
Okay.
If Hassett were to say it, it's party line. But if Dissents, but now Powell says it, and it's all fine. The reason I wonder whether it matters is we have midterm elections coming up, and at the joy of being political, people care about the price of meat. The people care about other things, and yes, rent is one of it. But of course, the cost of housing is more than the cost of rent. It's the cost of insurance and other things. By the way, one of the reasons why we're increasing renters isn't just because we can't afford to buy the house. It's also because states have these onerous regulations on insurance companies that less insurance is offered at higher prices. And when you are a corporate buyer, you self-insure. then you don't care about those rules. And that
Right.
makes it more cost effective for big business to own your shelter and then lease it to you.
Right.
I think it's
Right.
far more
Plus, they
relevant.
can borrow at cheaper rates. I mean, there's just a whole other litany of advantages they have.
So to me, it really matters how the consumer feels. And currently, the consumer feels rotten, right? I mean, maybe because they're listening too much to social media about everything that's bad in the world. But it used to be that the party in power, folks felt good, and the party out of power felt miserable. Now everybody feels miserable. They keep spending, though. And so I say that yes, the Fed might use it as an excuse to do something, but it really seems to me that the underlying drivers, people are so far apart about what's going to drive. Is it going to be productivity growth? We have to foster, and let's not kill an economy, or is it the inflationary fear? Because let's not forget the reason why some people are hawkish is because they remember the 1970s. And you don't want to be wrong on this. And they'd rather err on the side on being a tad too hawkish than to have had the supply shock, high inflation, and then say, hey, yeah, mission accomplished. And because then it just gets more and more expensive.
Right. And you get stuck in the Arthur Burns cycle. And
Well, exactly. And so I'm not so sure whether the actual CPI matters so much. Of course it matters, but there will be things in there to appease everybody. Now, back to kind of the core question, what about the tariffs and services? If the economy is slowing down, services should be becoming cheaper. It's one of the reasons why I'm a tad pessimistic about the economic growth.
Mm-hmm.
And as far as tariffs are concerned, we have no idea, right? I mean, people were hoarding inventory. We have a Supreme Court. If the Supreme Court acts as tariffs, we're going to have some other ways of imposing tariffs. My own thought is that, again, we have a midterm coming up. It's in the administration's interest to have some calm come into this environment. And so we might get more clarity. Also, obviously, we're down from these very high tariffs that we're, quote unquote, just negotiating towards.
Right.
The other part I think we tend to neglect is the US economy is far more shielded from what's happening internationally than most other economies.
Right.
We don't import all that much. Somebody pointed out to me,
and we don't manufacture, so our exposure to the business cycle is less.
Yeah. And by the way, somebody pointed out to me, is that 18% of the economy is healthcare? So that may matter much more to many people. And we have an aging economy, so they will consume more healthcare. I don't know how much you paid for your little visit.
I mean, we all pay too much for healthcare. Yeah. The cost of a tooth extraction replacement, folks, is not cheap. And I'm sorry to interject, but let me just ask you, this is too much of a sidetrack, so feel free not to answer this, but like, personal opinion, the majority of healthcare spending in this country is not productive. Meaning, unless it's being spent on, preventative stuff that's keeping young workers in the game longer, we're basically, most of our spending is on stuff, people who are unwell, aged, whatever, and we're keeping them alive, which is notable, but we're not getting an economic return off of that. So this whole thing of like measuring healthcare services as part of GDP, it's always bugged me, because it's just like, it's not really contributing to economic growth.
Well, if we can keep you working another year, maybe it does. I mean, there is so much messed up with the healthcare here that it's the most recent initiative, I think, was one of the better ones. The initiative that maybe people should be able to buy their healthcare at Costco's or Amazon. I think it is an absolutely terrible idea that people get their healthcare through their employer. And the reason why that's such a terrible idea is that it makes you dependent on your employer. If your health isn't good, you can't afford to quit. That's a terrible, terrible situation. The other terrible thing about healthcare is that you have to renew it every year. That's just completely stupid. You should get your healthcare at birth, some subsidy for who have have conditions at birth and then make it a personal responsibility to keep that up in life. And
Right.
those who do pay a lower rate than those who do not. But of course, as you age, you're going to get more sick, right? And that's why you pay in early. But if you do a reset every year, that's why you need to have all these pre-existing conditions, exemptions, and you end up only getting healthcare when you're sick. I mean, none of that makes sense, right? And then the government comes to fix it and making it worse. So I mean, that's a discussion that goes a little bit beyond today's meeting here, but you could get more efficiencies out of the system, and I guess you could measure it. But that's all of that is a discussion for another day.
Yeah. Let's not go down there. All I was saying is we there's a lot of people that talk about it as a good thing. Oh, healthcare is becoming a bigger part of the economy, but I'm just like, why? Why do we value that? Because it's not providing incremental growth. But anyways, we'll talk about that later on. Okay, another important thing, another thing that caught my attention that Powell said is, hey, the labor market's cooling, and he said, hey, we're kind of in this awkward spot where risks to inflation are to the upside, but risks to unemployment I think you said risks to deflation or inflation are to the downside, but risks to unemployment are to the upside.
There we go. He managed to confuse everybody.
Yeah. So, but basically, he's like, look, we're kind of looking at. He basically said, look, we're kind of looking at unemployment. We know it's going up. We're not that worried about it. And if you look at our projections, it's going to go down over the next couple of years. But then he said, our payrolls are running right now at about plus 40,000 a month. But we know that data is kind of murky, and so we put our own discount factor of about 60,000 a month on that, meaning we think kind of the real job growth is negative 20,000 a month. And I was like, wow, I didn't realize the Fed thought that we were actually on a net loss for jobs right now. So any reaction to that, but in general, but also too, like, to me, I can, to your point earlier, I can make the bull case and the bear case for the economy next year. I can agree with the administration, and we're going to start getting the tailwinds of all their economic policies starting to fire on full cylinders, and we'll have the lag effect of the rate cuts kicking in and all that stuff, right? But I can also make a pretty gloomy outlook as well. But to me, it all hinges around what happens with unemployment.
Well, let me make the political case. People will blame AI for the job losses. They will increasingly blame AI for driving up the electricity prices. If they build a data center in downtown of my hometown, my electricity prices go up. And so politicians will try to, and possibly succeed in reducing growth in that area. And to me, that's a risk factor. I think that's underappreciated in the growth. Obviously, AI might accelerate some outsourcing because you don't need entry-level jobs for certain things. But I think the reason why entry-level jobs are not abundant is because of the minimum wage. I mean, California has the highest unemployment rate, I believe, in the U.S., and it's because we've shot the minimum wage to the roof. Basically means that if you don't have any skills that are marketable, you're not going to get a job, at least not legitimate jobs. You're driven to illegitimate activities where you don't have a minimum wage. And it's good intentions creating issues rather than, especially teenagers, right? Teen unemployment. I get it that living costs are
college
expensive.
Graduate unemployment is the highest it's been in a long time.
Yeah, and but expectations are very high, and of course the other problem is that it's way too expensive to live anywhere where there are opportunities. I mean, what we start seeing happening, and I think that's going to be a trend for a while, is that employers create corporate housing. I mean, it's to enable it to people.
That's a dystopian future, right? That's back to the company store, right? Where you're just you're just living in servitude
that's in your future. I'd rather go to the corporate store to get a sandwich than get my free food at the company than getting healthcare from the company. because that I think has longer term implications. It's
Right. But
easier
what if you're dependent on the company for everything in the future? Right. That's
yeah.
So
well,
okay.
I mean, we ever more dependent on the government for everything. Look at how many people are on entitlements and whatnot.
Right.
And we're having a huge fight of whether to reduce Medicare for some people that really don't need it. So it's getting rid of benefits is just extremely difficult, and that's part of this thing. Of course, we have a generation now almost that believes capitalism is all rigged, and you can't blame them with all the bailouts. That's what they're thinking, right? Mm-hmm. And they want to just kill off ideas for growth, and those are headwinds. I think that might not happen next year, but those are headwinds every one of us can fight by arguing for less regulation and allowing the free market to play a little bit bigger role.
Yeah, well, I think we're already seeing a lot of those headwinds politically. As we're seeing a lot of the recent elections, go more towards some of these progressive candidates that are trying to present an alternative to capitalism. But that's, again, another discussion for a different day. So, Axel, in the remaining time we have left, because I'd get shot if I didn't ask you about it, I do want to talk about the action in the precious metals, most notably silver. Before we get there, is there anything else about the Fed's announcement today that I haven't asked you about that you think the audience should know about?
I think we covered a lot. I might filter some in as we talk about precious metals. And since you're from the silver state, we can talk about silver too.
Let's exactly, now that I'm here in the silver state, which is funny. I found out that Nevada is like one of, I almost want to say the most largest gold producing regions in the world. And it's funny to me that it's called the silver state instead of the golden state, which your state is called, but we make more gold. We mine a lot more gold than you guys do.
Well, and folks in Nevada understand commodities. Folks in California don't, or at least no longer.
Yeah. All right. Well, let's talk about silver. So this week, silver had it's been price breakout after price breakout, but a big one just blowing through $60 an ounce like it was nothing, like it was tissue paper. And I believe, I'll check while we're talking here, but I believe it's up to, at least silver futures are up above $62.
I will never forgive you for quoting futures prices. It just...
Well, the reason why I do is because Yahoo Finance
no excuse,
silver prices right next to each other.
No excuse. You're supposed to be into the real thing. Yes.
Okay. Well,
so
anyway,
61.86 on the spot. Yeah.
Okay. So on spot, it still is almost at $62. And is that a real time? Like does that continue after the stock market?
Well, there's no liquidity. It's you should have seen Friday after Thanksgiving, the market closed at 1 Eastern time, and precious metals prices moved significantly so. But I mean, what good is a price if there's no liquidity? And so it's
all I wanted to say is that as well as silver has done in the past couple of days, it has popped further post the FOMC release today. It is enjoying.
There was volatility, but the liquidity mattered, and everybody's happy.
Yeah. Okay. So, anyways, we've got this real-time breakout going on in silver. So, you as a precious metals aficionado, but also a gentleman who owns and controls a mining fund, what are you thinking about all this action?
Well, it's an interesting world we live in, right? I mean, historically we have an easing cycle at the Federal Reserve. We have a fiscal deficit that's just tremendous, given where we are in the cycle again. We have tariffs, which, in my view, help precious metals because it increases pressure on the Federal Reserve as deficits need to be financed more domestically because you're preventing the currency to come into the country in the same degree. Mm-hmm. And notably, and we've discussed it, I believe, a lot of the more fringe views in the precious metals communities are moving more towards mainstream. And these markets are not very big, and that's why you have these outsized returns. And of course, what differentiates silver from gold is one of the differentiations is that it has more industrial use. And so when there is the thought of more economic pickup, then silver can do extraordinarily well in comparison to gold. And so obviously silver is notoriously volatile, and that can reverse in a heartbeat. That's the one thing I like to caution. I had a chat with somebody the other day. He said, "Oh, I convinced my brother to sell his stock portfolio and buy silver." And I can't give specific investment advice. And I like silver, I like gold, but I cannot, by censorship of my regulator, can tell people, hey, sell all your stocks and buy silver. It's just orders of magnitude more volatile than the stock portfolio is. And so you just want to keep that in mind if you were to do any such shifts. And but in any case, we have these commodity prices high, and then the mining companies have done well, but nothing compared to the profitability that these prices are suggesting. And one of the things that's somewhat special in this environment is that while there have been cost pressures, they haven't been all that bad. Labor markets in the mining industry are getting a little tighter, not as tight as they have been in previous markets, but especially the good management teams are continuing to attract good talent. Commodity prices are well behaved. Mining is very energy intensive. Tax demands haven't been dramatic. Obviously, we've seen Mali, for example, and some other places where governments want to have more taxes as precious metals prices go up. But overall, it's been a very, very positive background.
Okay, so very positive background, although you just mentioned a few things there that made me think you're a little bit nervous about prices
today. To be
nervous.
I am paid to be nervous.
Okay.
So we've clearly, I mean, there are different types of buyers in most markets, but let's take the precious metals market. You have the person concerned about purchasing power. You have the diversifier. You have the central banks. You also have the speculator. And the speculator was absent for several years,
right.
Busy with meme stocks, SPACs, crypto, whatever it may be. And the speculator has taken an interest again in precious metals. And if you ask me whether I'm nervous, well, the speculator increases volatility.
Yeah.
And it's just part of my job to remind people that volatility happens both on the upside and the downside. It feels much better on the upside.
Absolutely. So on the speculator side of things, that's recent, as you were saying. And this is how these cycles work, right? Is the industry starts recovering, and the early people watching get in, and they ride, the gains up until the point the speculators notice this, and then they pile in, and then you get your overvaluations. Where does your gut tell you we are on the speculator side of the story? Let's use innings. Are we still in early innings here, or do you have concerns that we might be in a late stage speculative run?
It's very difficult to say. I would say we are somewhat in the middle, probably on the speculator side.
Okay.
But I like to remind people also that Greenspan warned about irrational exuberance in 97. The bubble didn't burst in 2000. I'm mostly referring to AI. I don't think given where we are in precious metals, there's any bubble whatsoever on the mining side. Clearly, some deals get funded that we have no interest in participating in, and in the bull market, a lot of deals get funded. And but whether that lasts for 3 months or 5 years, nobody knows. And so it's difficult to assign an inning to that. I do believe that the large miners had some rough patches, but they are doing a few things to get their act together. It's part of the reasons why the large miners have performed well. Mm-hmm. Ultimately, though, the large miners have an extremely difficult time growing. It's just that you can't find enough metal in the ground quickly enough.
Right.
And so what we're doing is we're looking for smaller companies that have catalysts beyond the price of the metal that might warrant an upside.
And because they're acquisition targets?
Not just that, but because they're reaching a new phase of their growth. They're added to an index. They when you get a permit, you might get. So there are other reasons why you might
get a valuation bump. Yeah.
So we see lots and lots of opportunities out there. And so in that sense, I don't think we're in a bubble at all. Now, if it comes to the actual commodity, I might be in my own echo chamber, but I can rationalize why we are where we're here. Clearly, we've had a very positive year, and it's anybody's guess whether next year will be as positive. If you take historic context, a lot of arguments can be that we should, right? The Fed is in an easing cycle. Economy might be slowing down, but hey, If we are in a growth cycle and the Fed is going to be tightening, then maybe not. But if the Fed continues to be, so what was harmful to especially the small miners, but the commodity price in general, to the precious metals prices, was to have the higher for longer environment. Right? And that is high real interest rates. High real interest rates means you might get compensated for holding cash, and that's harmful. So today, real rates dropped. The question is, on the risk side, what could get real interest rates to move higher? Gridlock in Congress, maybe canceling all the growth ideas. But even with gridlock in Congress, this administration has done a lot of things on the executive side where they have done things anyway. But that's where you want to focus on the risk side. Will we have higher real interest rates? I think those odds are pretty low, but
pretty low, yeah.
Never zero.
And the market certainly seems to think they're low.
Yeah.
Okay, so we only have a couple minutes left. So I want to ask you this question that I've been getting asked a lot lately. And I'd just like you to clarify it for folks, Axel, because you're one of the guys that really understands this space well. You have ETFs out there like Ounce, ETF that you were personally involved in creating, that say that our ETF holdings are backed, dollar for dollar with ounces, right? I had heard, and this is a long time ago, 10, 15 years ago, oh, you don't want to hold ETFs like GLD because they're not fully backed by ounces. They own a lot of futures contracts, and therefore you've got counterparty risk. So if the inventories got tight, they might not actually be able to get enough ounces to fully back what's in the ETFs. Relatively recently, I've gone and looked at their prospectuses. I don't think that's the case, but can you just comment on the delta in like safety and security and affordability of the various precious metals ETFs, or is this just a perception issue when they're all pretty much the same?
I would love to do a separate program with you on that.
Sure.
Unfortunately, my hands are pretty much tied here in this venue to discuss that too much. Okay. The only thing I can say is that over, I think 18 years ago, we looked at these very, very closely, and we decided to come out with a product that addresses a lot of these concerns.
All right. So there were reasons,
but I can't go any further into detail whatsoever, unfortunately. What I can encourage people is to come to our website to learn more about what we're doing. And for those who don't know me, we manage over $3.5 billion in gold and gold mining, in both the physical but also in supporting mining companies. And then let's talk another time, maybe specifically about those physical gold ETFs, because there are fascinating things in there. I think they're very poorly understood. And yes, they serve a purpose, and I think if used right, some of them I think offer good value.
Okay, so I've put your website here on the screen, merkinvestments.com. Folks can go there to learn more in real time. I don't want to get you in trouble, Axel, but if you come on in a future time and we try to talk about this, can you?
If we focus a session on that, yes, I'll make sure we can. Yes.
Okay, great. And then I just want to put up your X/Twitter handle here so folks can follow you there as well. And for those listening, it's at Axel Merk. Axel, we are right at the point where I told you I would let you exit. So please feel free to go do that. But thank you so much. This has been a wonderful discussion as always. Folks, please thanks Axel in the live chat here. And don't leave just yet because I've got one last update for you. But Axel, you can leave right now, and I'll catch up with you a bit later. But again, thanks so much for continuing to do this. All right. See you, buddy. All right, folks. So I just want to remind everybody, in case you don't subscribe to my Substack or you haven't opened the email I sent out yesterday, but you've probably seen me interview Andy Schechtman on this channel quite frequently. I had Andy on last week. We were talking about the breakout that we had seen in silver back then. But in the recent days of silver blasting above $60 an ounce, I reached out to him and said, hey, is there anything we can do for for the Thoughtful Money audience, sort of in celebration of this milestone. He said, absolutely. I'm happy to offer Thoughtful Money followers the exclusive special offer of buying junk silver from Miles Franklin, which is Andy's company, for $1 under spot price. So if that sounds like something that you'd be interested in exploring, then just go to thoughtfulmoney.com/buygold. Fill out the form there. It's a super short form. It'll take you like 30 seconds to fill out, probably not even that much. And then you can get the details from Andy and whether or not you want to take advantage of that specific offer too. He and his staff are there to address any questions or needs you might have about buying or storing precious metals in general. So I just wanted to make sure that everybody was aware of that opportunity. And if you want to go check it out, like I said, just go to thoughtfulmoney.com/buygold. All right, folks, thanks so much for joining on this. I am planning on continuing to do these post-FOMC release live streams with Axel. But obviously, I love to focus most on what you guys want me to do and do less of the things that you don't want me to do. From feedback that I've gotten continuously, it sounds like you guys really enjoy these sessions with Axel. But again, let me know in the live chat here, or if you're watching the replay, let me know in the comment section below what you'd like me to do. But obviously, if you want more of this, we'll continue doing it. That being said, thanks so much for watching, everybody. If you can, please let Axel know how much you appreciate him coming on here by hitting the like button and then clicking the subscribe button below, as well as that little bell icon right next to it. Hope you all are doing well. Happy post $60 silver day to you. And I look forward to talking to you guys again. I think the next video coming out tomorrow is with Ted Oakley of Oxbow Advisors. Then we'll have Lance on the weekend. So we got a lot of good content coming up. Thanks so much for watching, everybody. We'll see you soon. Take care.
What percentage of gold backing the rest of the Fed's balance sheet would make the rest of the Treasuries trustworthy to hold for people. And if we go to the 1980 numbers, it's something like $40,000 to $50,000. If we are to equate the dollar value of those 235 million ounces to the rest of the pile on the balance sheet, which is the monetary base, it would have to be 30 to, I think it's about 50,000, or it could be 55,000, somewhere around there, like between 40 and 50 or something like that. It doesn't really make a difference. But that's what we're talking about. I'm not talking about covering M2. I don't think we're going to get there because to cover M2 is what, like 21 trillion, whereas the monetary base is like 5.6 trillion. It had to be 4 times that. I don't think we're going to see $200,000 gold. I think the dollar's going to break before that.
In 1980, the market drove gold higher because investors no longer trusted the Fed's debt-heavy balance sheet. Gold rose enough to fully back that debt, restoring confidence. Applying the same logic today, with the Fed holding about 235 million ounces of gold against a $5.6 trillion monetary base, gold would need to reach roughly $40,000 to $50,000 an ounce. Covering the broader money supply would imply $200,000 gold. Rafi doubts it will reach that point, expecting the dollar to collapse first. Rafi Farber is a financial writer, investor, and commentator often referred to as the endgame investor. He explains that gold is real money, and when its price changes, it's not gold being revalued, it's the dollar. History shows 2 forms of revaluation: statutory, like in 1933 when FDR raised gold's price from $21 to $35, fueling inflation, and market-driven, like in 1980 when distrust in the Fed's balance sheet drove gold up to around $850. Both have the same effect, shifting the value of the dollar, just through different forces. A recent Federal Reserve analysis into gold revaluation mirrors a broader concern over the dollar's stability. While not signaling immediate policy action, it underscores the extent of fiscal stress. These discussions signal deeper doubts about the sustainability of fiat frameworks. Today, stresses in the dollar system are showing up again in the gold futures market, where spreads across maturities resemble those seen in the 2008 and 2020 crises. This suggests another monetary breakdown may be near. While the timeline is uncertain, the underlying truth remains: gold is money, and its role as the ultimate measure of value won't change no matter how the dollar performs. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
What it means that gold is the money. If the gold is the money, then every time the price of gold moves, it's revaluing the dollar. Gold doesn't actually get revalued. The dollar is being revalued. Now, the question is, are we talking about statutory revaluation or market-based revaluation? You just cited two examples, one being 1933, which was statutory, right? FDR just decided, maybe on some advisement, maybe on a whim. I remember I read when I was turning libertarian when I was younger, but he was talking about, I think in his book, Broke, how FDR just decided on a whim to make it 35. I don't know, he was just like flipping numbers in his head and he decided that was the one. Could be true, I don't know. And then you were talking about the revaluation in 1980, where the price of gold in the market that you could get a gold coin for to shop was what was being revalued, and that hit 872 or 850, wherever you want to count the top. And ultimately, these are really the same thing. Right? They're brought about in different ways, and that's but they are monetarily speaking, what is happening in the monetary system. It's the same thing. It just the difference is who's acting upon it. Like if a 50 kilogram weight drops on your head, you're not going to really care that much if it was, like, say, a meteor from God. Or let's say somebody had sinister would drop something on your head from 100 feet above you, or drop the piano on you. Either way, you're dead. It doesn't make a difference. So I don't think we're going to have a statutory gold revaluation. And what happens during a statutory gold revaluation? Well, you look at the price inflation statistics, which we have from the 1930s. And in April 1933, I think the deflationary, and I'm talking about consumer prices, the deflationary statistics were something like -9% a year. And then by about 10 to 12 months after the revaluation from 21 to 35, price inflation shot up to positive 10, 15% or something like that, like a huge move. And really that was the point, because by revaluing, that gave FDR's government, or the Fed under him or beside him or whatever, the ability to print more money based on that gold revaluation, and then the inflation came from there. If there are problems with the dollar, then what you would see is spot gold going pretty high relative to other maturities, but going out into the future, I think you would compress in the middle, and then the price would go higher out into the future, because you'd have speculators that are also worried about the dollar, because they're using gold to speculate because they see something wrong with the dollar. But also you have the people at the mouth of the pipe, the big banks, and they are going after spot gold itself. So you're having these like kind of zigzaggy, wavy maturity scheme. And I think that's what's happening now. But you'd have to look at a chart of this. It's available on Gold Charts or us to see all the maturities and the different colors of the lines, and they get wider as we get closer to a crisis. So the chart goes back to, I think, 2005, 2006. The only time I've seen the maturities be this spread out are 2008, 2020, and now. So the question is it happening again? And there are other signs that corroborate it. How far out are we? I don't think we're very far. People say, like, I've been around since 2020 saying the same stuff, but it's 2025. Even 5 years is not that much time. I know that's kind of a cop-out, but it's also true, and gold is still money. I mean, it doesn't really matter, because I know what the truth is. People can say what they want, but the reality is reality. It's not going to change.
Rafi thinks that the financial system is like a giant pyramid with gold at the base and countless layers of debt and derivatives stacked on top. Nothing can replace this structure. According to BIS, proposals like the stablecoins can boost liquidity and payment efficiency, but they don't fix the financial system's core weaknesses. They only add another fragile layer. Their heavy reliance on US Treasuries exposes markets to volatility, where sudden redemptions could spark liquidity shocks. Even with new rules like the Genius Act, critics argue regulation creates only an illusion of safety while deeper risks remain. Eventually, a crisis will force people holding stablecoins to convert them back into cash, triggering a rush for dollars. At that point, the Fed will have to step in and monetize debt as always, because the underlying pyramid hasn't gone away. These measures may provide short-term liquidity, but in reality, they make the structure even weaker, like stacking jello on top of bricks. One small shock, and the whole thing risks collapse. Now, let's review the interview.
No, it's not going to replace anything. All it's got, we're on a pyramid. The pyramid begins with gold, goes up derivative layer by derivative layer to where we are now. And there's a lot of derivative layers, and you can argue about what layer is which layer and where is it in the pyramid and all this stuff, and it's very complex. But there's no getting out of this pyramid without it either falling over or building a new layer that looks new, but it's really based on everything that's on before. Right? All you can do is build one more layer. So if they do this Genius Act and stable coins, and obviously there are serious threats to personal liberty involved with stable coins, fine. I don't dispute that at all. And I know that the government wants to take as much liberty as they can from us, reasonably, as much as they can reasonably get away with. They tried taking away almost all of it in COVID. There was backlash, and Trump got reelected. I'm really oversimplifying, I know, but I don't have time to get into geopolitics here or anything like that. But what the Stable Coin Act or the Genius Act, whatever they're calling it, can do is it can turn T-bills into a more liquid asset by making them tradable. If people are going to take stable coins as settlement for payment, then it turns T-bills into basically dollars. So the Fed wouldn't have to monetize that debt as quickly, theoretically. But sooner or later there's going to be a crisis anyway, and then everyone with stable coins is going to they're going to need cash, so they're going to have to sell out of their stable coins to get dollars, and there's going to be a rush on dollars, and then Fed's going to have to monetize it anyway because all of this pyramid is still there, and all prices from today are still based on yesterday. No matter what the hell you do, there's no getting out of that ever. Just like there's no breaking the law of gravity, you cannot fly without counteracting gravity with an opposite force pushing down. It's not possible. So at that time when suddenly there's a dollar crunch and everyone has to get out of their stable coins to pay their bills, right? Then the Fed's going to have to take those T-bills, turn them into dollars by buying the T-bills, giving dollars to whoever needs to give dollars to whoever has the stable coins. We're going to be in the same place we are now. So the most this can do is provide a little bit more liquidity on the top of the pyramid. But I guess an analogy would be like instead of like a really heavy brick on the top, right, on the top layer, you'd put, let's say, I don't know, something a little more jiggly, maybe like Jello on the top. So you can build it higher, but it's like a lot weaker, and like a little bit of sun can melt it, and then it just falls over anyway. That's the analogy that just came to my head. Jello.
History shows that whenever trust in the dollar erodes, gold steps in as the ultimate anchor of value. Whether through statutory moves like FDR's revaluation or market-driven surges like in 1980, the effect is the same. The dollar weakens, and gold reasserts its role as real money. Today's fragile financial pyramid, propped up by layers of debt and experiments like stablecoins, cannot escape this reality. As stresses build and liquidity games run their course, gold remains the foundation that cannot be replaced, only rediscovered when confidence in paper assets fades. If gold does climb toward $40,000 an ounce, how might this reshape global financial markets and investor behavior? Could stablecoins and digital assets delay a monetary crisis, or do they simply make the eventual collapse sharper? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.
Gold is becoming more expensive. It is the dollar which is losing its purchasing power versus gold. The price has been steadily moving upward over the last 2 years. And it surges it breaks out, it surges 15%, it consolidates for another 3-4 months, breaks out, surges 15-20%, consolidates for 3 or 4 months. This has happened 3 or 4 times now. And as most people know, it's been consolidated under 3,500 since about April or May. It's now broken out, and I think there's a rush of speculative interest because another 15%, if we keep the pattern going, takes us up to about $4,000 an ounce. I think the next move is, in this current move, is probably to 43.5, 44. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through.
Gold's rise isn't about it becoming more expensive. It's the dollar steadily losing value against it. For the past 2 years, gold has followed a pattern of breaking out, surging 15 to 20%, then consolidating for a few months before repeating the cycle. After holding under $3,500 since spring, it has now broken higher, and if the trend continues, the next leg could carry it toward $4,000 an ounce. Silver, meanwhile, looks set for a move toward $43 to $44 in the near term, and with expected rate cuts and yield curve control ahead, next year could be when it finally breaks through the long-standing $50 barrier. Craig Hemke is a longtime precious metals analyst and founder of the website TF Metals Report. He recalls that back in 2011, silver's sharp run from $38 to $48 in just 4 weeks wasn't a bubble, but the result of a commercial short squeeze. Speculators were long while commercials were heavily short, and when shorts had to cover, prices exploded. If commercials pile on new shorts, silver will likely grind higher in a slow, stair-step move. But if they start covering without heavy speculative buying yet, that could trigger a breakout, drawing in new money and creating a powerful rally. Silver tends to sit quietly for long stretches, but once momentum builds, FOMO quickly takes hold. The current move may aim for $43 to $44 before pulling back, but next year, with rate cuts and yield curve control likely, it could be the time silver finally smashes through $50. If it does, tests that level as support, and holds above it, then the market could truly take off. If silver breaks above $50, the real stress will likely show in London's physical market, not comics. With supply deficits, limited float, and heavy reliance on paper ETF instead of real bullion, a surge in demand could expose shortages and trigger major volatility. That's when silver could truly get spicy. As we play Craig Hemp's video, kindly click the like button, subscribe to our channel, and enable the notification bell to receive fast alerts whenever we post a new video. I appreciate your support. Have fun watching the video.
Crazy breakout camp just yet. I think it's an important time for people to be paying attention to what's going on internally with silver. In April of 2011, okay, so most people remember that, price went from 38 to 48 in about 4 weeks of that month, over the course of the month. And it was assumed, it was written up, and people look back, with revisionist history and make it sound like it was a big speculative bubble. What was actually going on, if you followed the Commitment of Traders report back then, was a commercial short squeeze. They had all these speculators that are long, all these commercials that are short, and they started having to cover shorts for, without going into all the details as to who was short and why and all that stuff. But you could just see it on the Commitment of Traders reports. And that's what took it from 38 to 48. I think, could we have a similar month now? Of course. But we want to be watching those Commitment of Traders reports, because it'll tell you a lot. If the commercial side of that equation is aggressively adding new shorts this month, okay, well, we're just in that kind of stair-step phase, of 2 steps forward and 1 step back. But if we start seeing a lot of commercial short covering without a lot of new speculative money yet, and that's what drives us, well, then, when we get that breakout of, top of the cup, then you get this big rush of speculative money that just catapults you further. Because silver's a lot like, and I'm sure I've used this metaphor before, it's like Newton's law of inertia or motion or whatever it is. I took physics, but it was a long time ago. An object at rest remains at rest until a force is applied to it, right? Just sit there. My computer right here, but if I push it, okay, all right. It'll remain at rest until a force. And that's kind of what silver's like. Silver just sit there, as we all know, and just do jack for a long period of time, even like not keeping up with gold, because people are waiting. You're like, well, I'm not going to get involved in silver yet because it's just sitting there doing nothing. But then as it starts to get moving, then you get this kind of FOMO thing. Hey, we've seen this before. And so what will probably happen, I would not expect it to smash through the $48 to $50 all-time highs in the first try. That's generally not how it works. And so I wouldn't think we would get there this year. You go up, we could go to, I think the next move is, in this current move, is probably to 43 and a half, 44, given the channel that we've been tracking higher. Pull back, maybe under certain conditions, we make another run later this year. I think it's in next year. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through. You go up, tap it, find resistance, finally break through. Everybody goes crazy, and then it pulls back, tests that old resistance level for support. And if it finds the support and you stay above 50, and then start making new highs after that, well then, holy Toledo, then we could have some fun. And this all the stuff we've talked about all these years, Elijah, about how much silver is there really in the world? The supply deficit over the last 4 years. How much free float is there in London? How many ounces are levered? How many times supporting the derivative markets? All that stuff. If we set off on this, break through 50 and everybody starts getting excited and the banks don't want to fool around with it anymore because they don't have it, they don't want to deliver theirs out or whatever, things could really get spicy next year. I saw that stuff too last week. There were 9,000, I can't remember, 9,900 or something COMEX September silver contracts that were open and standing for delivery when that contract went off the board. And then it gets delivered against, you got to be 100% margin long covered so that you can take delivery if that, you're long and somebody in a short puts the silver to you. And, historically, that's a lot. But back in March and May, we were doing 15, 18,000 contracts. Okay, so it's not like, oh, wow, it's 10,000 in September, the system. No, it's not. No, not yet, at least. Okay, but it is a not insignificant amount. If we've already delivered almost all of those, that's 50 million ounces. I don't know if it ever actually leaves the COMEX or if it's still just this, oh, this month I'll take delivery, next month you take delivery stuff. So we'll keep an eye on that. I don't think that's where the stress is. To me, after kind of getting excited about that 15 years ago, I don't think that it's the COMEX where you'll see delivery stress. It's more likely in London. I'll give you this. I mean, you've seen over the years, Elijah, and I'm sure everybody listening has seen this, we're like Stan Druckenmiller or Ray Dalio or, whomever, some big hedge fund manager, they'll say, we want to own gold. And you're like, good. And then they buy the GLD, right? And you're like, well, what good is that? I mean, that gives you price exposure, but you don't really, you can't take delivery, Stan. You can't take delivery.
Craig Hemke explains that the dollar index is misleading, as it only compares the dollar to other weakening fiat currencies. While it appears stable, all major currencies are losing purchasing power together. Recently, talk of yield curve control has quickly gone mainstream, signaling that central banks may soon cap long-term rates to contain debt costs. The U.S. looks set to follow this path, echoing past strategies to manage high debt. If that happens, it would echo what the U.S. did after World War II, when debt-to-GDP ratios were similar. Back then, the Fed and Treasury worked together to hold rates down, effectively inflating away the debt with cheaper dollars in the future. We could see something similar soon, especially if Fed leadership changes. This would likely require massive new quantitative easing, with central banks buying and monetizing their own debt in a move resembling modern monetary theory. Such a shift would push real interest rates deep into negative territory, and that's extraordinarily bullish for gold and other precious metals as fiat currencies are steadily devalued.
The deception of the dollar index, because it just compares the US dollar versus all this other equally worthless fiat, right? And so the dollar over time, you pull up a 30-year price chart of the dollar index and it's, it's 100 and it goes up to 120 and down to 80 and it just stays basically the same. Well, that's because all the other fiat currencies are devaluing at the same rate. But I said, expect more rate cuts than what people are thinking are coming. And furthermore, don't be surprised if by December, the December FOMC meeting, the Fed isn't openly talking about yield curve control. And I mean, I wrote that like on New Year's Eve last year. There were nobody talking about yield curve control. But now, all of a sudden, here in late August, early September, it's like, oh yeah, yield curve control is coming, like everybody was predicting this 8 months ago. Yield curve control is coming. Whether it's globally, if all these central banks have to do that to control the long end of their curve, right, and control their interest costs. But I think you're definitely being told and warned that it's coming here in the US. And I think that's all part of what's driving gold too, because that would be extremely bullish news for gold. You'd be holding real interest rates sharply negative. I mean, the US has done this before, which is why I wrote about it in my pod. I even put a link in there in that macrocast, because coming out of World War II, when we had similar debt to GDP ratios, that's what they did. They kind of combined the Fed and the Treasury together. They did yield curve control, essentially to pay off the debts of yesterday with the cheaper money of tomorrow, right? Get it under control, grow your way out of it, which is what Bessent keeps talking about now. Well, anyway, if you want to take the time, to connect the dots, I mean, I think they're telling you that's what's coming as soon as next year, once Powell gets replaced and everything else. And so if that's the case, they're going to be trying to cap the long end. It's going to involve a lot of new quantitative easing measures, central banks buying their own debt, monetizing, almost like a modern monetary theory move. Again, all of this is extraordinarily bullish for the precious metals in terms of devaluing the existing fiat currency.
Both gold and silver are flashing signals of major shifts ahead, fueled by monetary policy, debt dynamics, and the growing disconnect between paper markets and physical supply. If central banks resort to yield curve control and deeper monetary easing, precious metals could enter a new era of explosive gains, marking a turning point for investors who have been patiently watching these markets build momentum. Do you think central banks will be forced into yield curve control sooner rather than later? If silver finally breaks above $50, will physical shortages in London expose the true limits of supply? Leave a comment below with your opinions. We would be delighted to hear from you. Please remember to subscribe for more material, and give this video a thumbs up if you found it useful. We appreciate you joining us on this adventure.
In the next handful of months between now and the end of the year, silver is likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds. 100 to 200 would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LBMA delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? You know, do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. The annual production of silver is not increasing, it's plateaued, and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it, okay? And that's a good excuse. Oh, well, the industrial demand, well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax. simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.